Imagine a world where the very batteries that power our smartphones and electric cars are suddenly more scarce than oil. That sentence isn't a sci-fi teaser, it's the quiet alarm ringing through the corridors of the World Economic Forum's latest Energy Transition Index. In the first quarter of 2025, the supply of critical minerals, lithium, cobalt, rare earths, tightened faster than any fossil fuel shock we've witnessed in the past decade. What makes this moment unnerving is the scale. Over 80% of the growth in global energy demand now originates from emerging economies, yet more than 90% of new clean energy investment since 2021 has been funneled into advanced economies and China alone. The mismatch is a textbook case of demand outpacing capital, a dynamic that economists flag as a precursor to price volatility. For the average household, the ripple effect is already visible in the price tag of a mid-range electric vehicle, which has risen 12% in the past 6 months. In Europe, utility bills have crept up as grid operators scramble to secure the rare earth magnets needed for offshore wind turbines. In the global south, communities that were promised cheap solar now face delayed projects because the necessary battery storage components are stuck in customs, waiting for a mineral quota that hasn't been allocated. The world is reacting. Governments are revising procurement policies, investors are pulling back from high-risk mining ventures, and a new narrative is forming. Green energy may be clean, but it is not cost-free. Yet, as we peel back the layers, a deeper question emerges. What hidden mechanisms are driving this perfect storm, and who truly holds the levers? While headlines celebrate solar's 30% cost drop, a silent bottleneck is tightening around the planet's most strategic veins. The bottleneck isn't a single mine. It's a complex web of geopolitics, finance, and technology. Critical minerals are concentrated in a handful of regions. China controls roughly 70% of rare earth extraction and 90% of processing, while the Democratic Republic of Congo supplies over 60% of cobalt. This concentration creates a strategic dependency that mirrors the old oil cartel dynamics, but with a twist. The minerals are essential for the entire renewable value chain, from wind turbine generators to EV batteries. A surprising fact from the World Economic Forum's Chief Economist Survey shows that capital costs for clean energy projects in emerging markets remain up to 7 times higher than in advanced economies, stalling project viability despite their lower mitigation costs. In parallel, the International Energy Agency notes that global clean energy investment reached a record $2.1 trillion in 2024, yet the flow to emerging economies, excluding China, is only about 15% of that total. Financial institutions are wrestling with this paradox. On one hand, ESG mandates push capital toward green assets. On the other, the high upfront risk of mineral supply disruptions forces lenders to demand premium returns. The result is a green premium that trickles down to consumers, higher prices for electric cars, premium pricing on solar installations, and delayed rollout of off-grid microgrids in rural Africa. The market is signaling a recalibration, but the most unexpected move is already underway. A wave of vertical integration where major automakers and tech firms are securing direct stakes in mineral mines. This shift could rewrite the rules of supply, but it also raises a new question. What happens when the very companies that sell us clean energy also own the scarce resources that make it possible? From the fjords of Scandinavia to the deserts of the Sahel, nations are watching the same mineral ledger, and their reactions are reshaping trade maps. Europe's response has been to fast-track the Critical Raw Materials Act, aiming to diversify sources and boost domestic processing. Meanwhile, the United States is channeling IRA incentives toward domestic lithium-ion battery factories, while Japan is investing in recycling technologies to reclaim rare earths from old electronics. In contrast, many emerging economies are caught in a resource trap. They possess the raw minerals but lack the capital and technical know-how to move up the value chain. Historically, the 1973 oil embargo offers a parallel. A sudden supply shock forced nations to rethink energy security, leading to the creation of strategic petroleum reserves. Today, the mineral supply shock is prompting the establishment of critical material reserves in countries like India and Brazil, a move that mirrors the old oil stockpiles but with a green twist. Behavioral economists point to a status quo bias that makes it hard for large utilities to abandon long-standing fossil fuel contracts, even when cheaper renewable alternatives exist. This inertia is evident in the slow pace of decommissioning coal plants in Eastern Europe, where sunk costs and regional employment concerns dominate decision-making. Yet, the same bias can be harnessed. Framing mineral security policies as job creation opportunities has proven effective in rallying public support in regions historically dependent on coal. As governments and corporations negotiate new mineral alliances, a subtle power shift is emerging, one that could redefine global influence. But there's a hidden layer. The race to secure these resources is also accelerating a technological breakthrough that could render many of these minerals obsolete. What if the next generation of batteries needs nothing more than seawater? Your morning coffee, your commute, even the temperature of your home, all now hinge on a handful of metals hidden beneath the earth. For families, the immediate effect is felt in the wallet. A recent survey shows that households in the global north are allocating an extra 3% of disposable income to energy-related expenses, while families in the global south are delaying essential purchases due to rising solar panel costs. Workers in traditional mining towns face uncertainty as the transition to green minerals reshapes labor markets, prompting retraining programs that are still in their infancy. What the mainstream media rarely mentions is the shadow market of informal mining that has exploded in regions like the Amazon and Central Africa. These operations, often unregulated, supply a significant portion of the world's cobalt and nickel, raising serious ethical and environmental concerns that are absent from most policy debates. From a market systems perspective, the green energy boom has created a dual economy. High-margin, technology-driven sectors thrive, while commodity-dependent regions struggle with volatility. The financial sector is beginning to price in transition risk, leading to a divergence in asset valuations. Green tech stocks soaring while fossil fuel equities linger in a limbo that could either recover or become stranded assets. The narrative that green energy is an unqualified triumph is being challenged by the very materials that enable it. As we stand at this crossroads, the decisions made today will echo for generations. Because while everyone is focused on the price tag of a solar panel, the real transformation is already unfolding, quietly and in a place no one expects. Stay tuned, because the next chapter isn't about the cost of green energy. It's about the cost of the resources that power our future.